Okay, welcome to the Wall Street Crossover Show, sponsored by Admiral Markets, and standing in for old Darren Sinden, who's on holiday at the moment. We have young Craig Drake, our very own in-house economist. How are you today?
I'm okay.
Right, we just heard, I think there was a little bit of Twitter speculation that there's been a 5-month can kick on the Greece situation, which seems to have perked up the markets a bit, as you might expect.
Inevitably, each time we've talked about this week, everything's been completely driven by Greece. There's been very few fundamentals driving the market. It's all about the sentiment of what happened in the last 30 minutes. Everything has been on a 30-minute timeline of everything that's going on with Greece, and I think ultimately it was the most likely outcome that they were going to kick everything further down the road, and that seems to have been what's happened.
So, even if this is not confirmed, it's confirmed yet, but even if it's still the most likely scenario, really, just a
Yeah, I think they're going to keep them going at least to the end of this year. I know I saw the William Hill odds. There was a 72 chance of a Greek exit this year, and 1 to 6 of them staying in, and I think that's probably pretty good odds that they're going to keep going for the rest of this year.
All right, well, let's see what data we've had over the European session.
Yeah, we had slightly weaker German import prices. I think that's because it's the first drop in 4 months, and that was driven by euro weakness, and they've managed to import a bit of inflation. But the interesting ones are these French numbers and the Italian numbers. French consumer confidence kind of held at 94, so there's a bit of weakness there. But the Italian ones have remained robust. The Italian consumer confidence, the Italian business confidence, and it's these Italian numbers keep creeping under the radar. Everybody keeps talking about the mess in Europe, but there are some strong numbers in there. Like the French consumer confidence is weak. The manufacturing numbers have been slightly more robust, and you see the same thing here in Italy. We've seen the consumer confidence index rose to 109.5 from 106 in the last month. 109 is a long way into growth territory. And we look at inflation expectations have decreased, and it's just you've seen that kind of strength there, and a lot of the business confidence we're seeing is linked to this Eurozone M3 money supply data that came through. We're starting to see, we're seeing that strong growth in loans to businesses, loans to households, and that was that number that just was completely frozen and completely crunched all the way through last year. No matter what measures the ECB pumped out there, no matter how cheap money was, no matter what kind of measures they put in place to try and get those banks lending to individuals, banks just didn't want to lend because there's so much kind of risk out there that they wouldn't lend it to any price. But now, arguably because of these QE measures that have been put in place, banks are finally sticking that cash out there.
Yeah, what this means is that the QE, which could have been done 5 years ago, should have been done 5 years ago. All that suffering has been for nothing.
Yeah, I generally...
Is that fair?
Well, the problem is that we haven't really seen any supply-side reforms happen. We've not seen any structural reforms. And my argument generally is, when it comes to these things, when people are saying banks aren't lending, there's usually a reason why banks aren't lending. Banks want to make money. If it's a good business to invest in, businesses will invest. In London at the moment, people are dying to invest cash. If you've got a good business, you can borrow money. It's a great time to borrow money right now. But throughout last year, part of the reason why banks weren't lending is because it's not a great business environment. You look at France, you look at Spain. Those aren't great places to do business right now. And I think they just got to the point where cash is so cheap that they are lending out. We haven't really seen those reforms just yet.
Okay, well, let's move on to the European movers.
Well, these are more kind of not just European movers, but what happened this morning. We've seen the big story this morning has been this crash in Chinese stocks. We're down 20% from its peak. It's down 7.8 overnight, down 14% this week. And we saw a note from Morgan Stanley saying this is not a dip to buy into. We had these huge valuations in Chinese markets. We've had this huge rally there. We've got this worrying level of margin debt that's happening, where people are borrowing to invest. And you see the amount of people who are borrowing against homes to invest in the stock markets, and that's always a terrible sign. We started to see those numbers hike up, and
that was sort of justifiable because there was a great rally in the first half of this year.
Well, absolutely, but I think as well as an issue, there's a trend of people investing outside the mainland. You get people who've kind of looked at Chinese market valuations and thought they're kind of a bit too lofty, a bit too high, and they've started to look at Hong Kong. They started to look at Shanghai and things like that, and they started to invest outside of those main stocks. I think that's driving some of that. And then the big one from the FTSE has been this recovery in Tesco.
Unbelievable.
Well, you see, there's always. I keep saying, like on our morning show, every time we do our stock picks, I'm always bullish on Tesco. You know, people talk about Aldi, people talk about Lidl, but there are some markets where it's great to be a smaller, more agile company where you can take advantage of not being so big. I don't think supermarkets are one of them. I think supermarkets are one of those sectors where having that supply chain, having that efficiency, having that clout in the market,
having a cartel.
Yeah, having those economies of scale.
Yes.
That's where you're going to survive. And Tesco, I keep saying this, are in a position to weather that storm a bit, and they have taken knocking. But the results this morning saw a drop, a slowdown in decreases in sales. They're starting to find their footing again, and I think lots of people have sat on the sidelines waiting to get back into Tesco, and the kind of results this morning of what they wanted, that kind of trigger to get people piling back in there.
But is it also, could also just be the case that having fallen from sort of £4 to £2,
yeah,
even if it's not a growth story or a fantastic story,
but that's value.
It's value. It's a value.
That's a value investment.
Right, and on the other side, the utilities.
Everything. I mean, when we look into the European markets, everything's talking about Greece. Greece is the tail that's wagging the dog here, and everything that's happening in European stocks. It's not so much what's happening at the fundamental level; it's what's happening in Greece. And maybe this news that we've just had over the last half an hour before we went on air, that's going to see a bit of a rebound there.
Right. Okay. Well, let's go on to the next area, which is the M&A area.
Yeah, I mean, we've seen Altice, who got knocked back on their bid for Boyd Telecom. They've gone through a bit of they're launching a new vehicle, so they'll merge into their Dutch company, Altice NV, so the kind of Dutch entity, to give them, to kind of strengthen that position for future acquisitions. Because when you look at when their bid got knocked back from Boyd, it was issues with execution, issues with financing. I think they're trying to get their ship in a bit better state. I mean, they've already bought 4 companies in the last year, in the last 18 months, so they're kind of out there. They want to buy. I think this move is to try and put them in a better position. The rest are kind of, we've got a bit of a rundown of what happened last night and what's happening, from after market results. Finish Line had very strong first quarter numbers. They're at 5.6% in pre-market. They saw earnings rise to 13.8 million, so they're strong there. BlackBerry have been those ones that have been floating around looking for a bid for a long time. They were kind of dead in the water, and if anybody was going to be a bid there, it's going to be BlackBerry, and maybe this kind of these latest numbers will get more people fishing for them. They had revenue increases, their software revenue increases of 150% to 137 million. And it's part of this fundamental shift in their business model. They're moving away from selling handsets and hardware, and they're moving towards being business software orientated, trying to expand away from just things working on the proprietary handsets to expand those. And
so the sort of more business-like clients will actually take up the
exactly. General Mills, they've taken a bit of a hit on restructuring plans. They in a regulatory filing yesterday said they're going to hack jobs as part of restructuring of the food company's international operations, and so they're obviously going to take a bit of a knock on that. Right.
Okay. And up to the US data.
Yeah, we've got this. Not a great bit of formatting here, but we've got our Michigan Consumer Sentiment Index out today. It's probably going to hold. We had strong numbers last time that it had kind of held up a bit at 94.6. We're going to see the same again today, but the kind of main, it's a bit of a quiet day today in the US. But we're going to see Esther George speak, the Kansas City Fed president. I mean, we saw
the Kansas City Fed is perhaps not the pivotal one in the central bank stage.
But I mean, when we're looking at the overall kind of trends, I think it's going to follow what we heard Jerome Powell say, who's a voting FOMC member yesterday. And this is another kind of expected to be another slightly hawkish speech. I mean, Esther George said earlier in the year that, she was the one pushing for a June rate hike, and pushing for this kind of normalization of rate hikes. Rather than saying that the risk is that if we start to wait until, I mean, we talk about the data-driven Fed, we've already got these strong jobs numbers. We've got employment at 5.5 and unemployment at 5.5%. That's pretty close to that kind of natural rate of full employment. So that's kind of taken care of. The next one, as far as data-driven Fed goes, is getting towards this 2% inflation target rate. But George has said, you know, if we wait too long before we start to try and hit that point, we're going to have to make up for it. The US is going to have to start making up for it with a load of hikes in succession. And it's maybe better to hike now and normalise.
Almost like when you don't really need to.
Yeah, I mean the case is, and it's lots of people have been making this case, that we need a normalisation of interest rate policy. You know, it's been so long since we saw rate hikes. We need to get the markets back used to anticipating them and getting back used to normal monetary policy.
Okay, well, let's see where the markets are at the moment.
Yeah, I suspect these are those pre-market moves. I mean, we talked about finish line already. Nike had their quarterly numbers out yesterday, and so we've seen big pre-market moves in there at 3.31%. Micron Technology, which we talked about on yesterday's show, they missed on expectations. They seen a big dump of stocks there. Accenture down as well. But I think euro dollar again is going to be that big move. I suspect these numbers are from an hour ago. I suspect they've changed very significantly since that Greek news. But this one that I kind of highlighted yesterday, we've got Euro Swiss, and we're supposed to be Dollar Swiss. We should be looking at Euro Swiss as well. I feel like this is going off a lot of people's radars. You know, lots of people got a lot of pain obviously this year.
Euro Swiss, yes.
Yeah, they got hit.
Might not be looking at that again actually.
Yeah,
for quite some time.
But I think that's an issue. I think people have taken their eye off the ball a bit with Switzerland. And with what's happening in Europe, we've seen that kind of strong upside, those strong gains in the Swiss franc. As the SNB said yesterday, they're starting to feel a bit of pain from there. And as we've seen, to our kind of detriment, you know, there's lots of people out there who've been hit hard. When the SNB wants to move, they move hard, and they do whatever it takes. They've got deep pockets, and so I think people need to keep an eye on those Swiss levels, because
it's interesting that 104 on the Euro Swiss. I mean, it's actually, let's say probably weaker than you might have imagined.
Yeah, but I mean,
allowing the market to find a level.
But I mean, they're still up 11% this year. That's a pretty, in major FX terms, that's a fairly big hike. And if you're a Swiss exporter, that's quite a lot to kind of swallow. Yeah. So it's if we get to the point at which they're really starting to scream, if the SNB moves, they'll move hard and move fast. And I think people need to keep a good eye on that pair. Right.
Any other markets that you really have a?
I think everything is just about risk. It's about risk sentiment in the markets. Again, that's been the story this week. We've not seen any huge moves in FX markets, and I think it's been a lot because of this nervousness of Greece. Everything's quite range bound, and I think that's the way it's going to stay for the rest of today.
Okay, that's it for the Wall Street Crossover Show. Thanks to Craig Drake, and we'll be back with this Monday at 1 p.m.